Hey, good morning, options traders. Welcome back, everyone. Well, there's been a lot of talk about flattening of the yield curves or an inverted yield curve, more so with the 10-year, but we still hear about what we would call the longer dated bonds, and that there's this tendency here recently for it to get flattened, or at least for the 10-year yields or the 30-year yields to become less than maybe the 1 years. Well, why does that happen? And more importantly, why doesn't the market like it when we get an inverted yield curve? Well, first of all, what is a yield curve? A yield curve is simply just a graph. We're going to look at time. These would be times to maturity. So maybe this could be a 1-year T-bill, looking at 2 years, 5 years, 10 years, and way out here at the far right would be maybe the 30 years. And on the vertical would be the percentage or the yields on these bonds. So what it shows is that maybe we're getting 1% down here for the short term, but as we go out to longer dated bonds, we start to get higher and higher yields. And then eventually they tend to flatten out up here. But the main reason that we have what's called a normal yield curve or an upward sloping one is because people expect to get more of a return on their money when it's tied up for longer. Plus, there's more risk. We're not really sure if we're going to get repaid or what will inflation be. There's just a lot more uncertainty out here, so people will demand higher premiums. So again, this is what we would call a normal yield curve. So, maybe down here for this example, I'm going to say that the 1 year, let's say, is trading for 5%, and maybe the 2-year bond is trading for 7%. It's just for examples, so just remember these numbers right here. But if we get an inverted yield curve, it might look like this. Flattened yield curve, just like the name would imply, would be more flat, but this would be inverted, where this left side is actually shifted higher than way out here on the far right. And this is a real puzzler. People are going, why does this happen? Why would investors be willing to take lower yields for much longer periods of time? And what does that signal to the market? Well, to see what's happening here, we have to, I never want to get into the math, but we have to talk a little bit about it. There's some yield math you have to understand, at least the basics. So let's say that we have a 1-year bill trading in the open market for $952.38. That's the price that we're seeing on our broker's platform. And we're interested in buying a $1,000 bill. In other words, that's going to be what's called the maturity value. When we get to maturity, we're going to receive $1,000. Well, what's the yield? Well, it's pretty simple. We're just going to say if we pay $952.38 times some interest rate, that's what we're trying to figure out, has got to equal the maturity value of $1,000. So we just work this backwards. We're going to say $1,000 maturity value divided by our price of $952.38, and that equals 1.05. So that's just saying that it's 1.05 times higher, or 5% higher. We've made 5% on our money. So it's this basic formula that we can mix and match in a lot of different ways to solve different problems. So I'm not going to step through it in the upcoming slides, but I just want you to know that's where these numbers are coming from. So now with that in mind, let's say that we want to invest for 1 year. And as I showed before, we have the choice of buying a 1-year bill that is trading at 5%. So as I just showed, that bill would be trading for $952.38 in the market, and it matures to $1,000. So there's our 5%. So that's one choice that I have. What else could I do? Well, maybe I could buy a 2-year bond that's priced at 7%, but sell it in a year. All right, so remember, what are we trying to do here? We're trying to invest for 1 year. I have one choice of buying the 1-year bond, where I'll get 5%. But I could buy a 2-year bond and sell it in a year, right? Just because we have a 2-year bond doesn't mean we have to hold it all the way to maturity. There's going to be some price risk in there. We're not guaranteed to get $1,000 face, but we could certainly sell it. So what's that bond going to be priced at today? Well, we're going to solve this in a similar way. We're going to take the future value, maturity value of $1,000, divided by its interest rate, 1.07, but we have to discount it back for 2 years. So this bill would be trading for $873.44 in the market. So now we have to say, well, what rate would we need in the market to be indifferent? So if I take this 873.44 price times 5%, I would need that bill to be trading for 917.11 in 1 year. Because if I could pay 873.44 for it, sell it for 917.11, I would in fact make 5% on my money. Well, what rate would we need to see in the market for that bill to be trading at 917.11? Well, we go back to this formula and we figure it out, and it comes up to be 1.0903 or 9.03%. So if rates in 1 year are 9.03%, or at least that's what this one's being priced at, then yes, I could pay 873.44, I could sell it for 917.11, and I would in fact make 5% on my money. So the point is that I can either buy the 1 year bill and get 5% guaranteed, or I could maybe take my chances, buy the 2 year bill and sell it in a year. And if rates are in fact 9.03%, I'll be indifferent. I would have done equally well. Well, like I said, we're at risk though. We're not guaranteed to have rates staying at 7%. What if rates are higher? Well, if we buy the 2 year and sell in 1 year, and let's say that the rates are 10% instead of the 9.03 that we would need to see to be indifferent. So if that's true, this bond, remember it matures to 1,000 face divided by 1.10, would be trading for $909.09 in 1 year. So remember, we paid $873.44 for it. If we sell it for $909.09, that's just a touch over 4%. We would underperform the 1 year bill that was trading at 5%. So if rates rise, you're better off buying short-term bonds. Or even if the market expects rates to rise, you're better off buying short-term. And so as everybody rushes out to buy these short-term bonds, the prices go up and the rates go down. That's why when we saw that normal yield curve, the far left side of it was very, very low in the graph. So if everybody is expecting rates to at least stay the same or rise, those rates at the short term are going to be very low. All right, well, now let's look at the flip side. What if rates are lower? So remember what our goal is here. We're going to buy the 2 year and sell in 1 year. But let's say that they're actually 8% instead of this magical 9.03% number that we need to be indifferent. They're actually lower. Well, what would that bond be trading for? 1,000 face with 1 year left on it at 8% would be trading for $925.92. So remember, when we bought this 2 year bond, we paid $873.44 for it. We could sell it for $925.92, and that's actually 6%. We would outperform the 1 year bond at 5%. So if rates fall, you're better off buying longer dated bonds. Or even if people think that they're going to fall. Remember, what matters are the expectations. So if we go back to our yield curve, again, maybe we see 5% down here, 7% up here, but maybe way out here they're 9%. Well, what's going to happen? This is, let's say, the 30-year bond. If everybody thinks that yields are going to fall, which of these would give you the most for your money? Well, if you understand the math of bonds, it's the 30-year zeros, because they are all of the cash flows sit super far out in time and they get the biggest discounting factor. So watch what happens with the 30-year zero. Let's say that we buy the 30-year and sell in 1 year. That would be another choice for us. So if rates are 9% on that previous graph, that bond would be trading for $75.37 today. I know it looks ridiculously small, but that's the power of compounding over 30 years. So you could pay $75.37, hold on to this bond for 30 years, and you would receive $1,000 for every bond that you bought for this $75 price. So if we're trying to make 5% on our money, this is the benchmark. Remember, one of our choices was to buy the 1 year bond and get 5%. What would we need to see to be indifferent? Well, if we can pay $75.37 for this bond, 5% higher would be $79.14. So if this bond is trading for $79.14 in 1 year, we would be indifferent. So let's go and figure that out. $1,000 face divided by some unknown interest rate. Remember, there's only 29 years remaining on this bond. We would need it to equal 79.14. So what is this rate? Well, that rate would need to be 9.14%. So if this bond is priced at 9.14% in a year, not 9% like it is today, then we would be indifferent. We would also make 5% on it. But what if rates fall to, let's say, 8%? What's that bond trading for after 1 year? It's trading for 107.32. See, the long end of the bonds here, especially with the zeros, the zero coupon bonds, get these unbelievable magnification effects. So if we could pay 75.37 and sell it for 107.32, that's 42% on our money. Who wouldn't want that? So what do you suppose happens when everybody starts expecting that rates are going to fall? Investors rush out, start bidding up the 30-year zeros, and they do this relentlessly because there's a lot of room to play here. I mean, who cares if it comes down to 40 or 35 or even 20, 25? They keep buying the 30-year bond, and this rate keeps getting pushed lower and lower. Now, on the flip side, what happens on the short-term bills? Nobody's buying them. In fact, they're all selling them. So those prices are falling and pushing those yields higher. Remember, there's an inverse relationship between the interest rates and the prices. So as the prices of those short-term bills start getting pushed lower and lower, those yields rise. And that's what's flipping this yield curve. Everybody's selling the short-term, and everybody's rushing out to buy these long-term. And that's why these yields are getting pushed lower over here. So when you see this, when you get a flattened or an inverted yield curve, it's a signal of an upcoming recession. So during recessions, the Fed typically lowers rates. And that's a sign of a stagnating economy and lower corporate profits. And that's why the stock market doesn't like to see inverted yield curves. So we're just working the process backwards. We're saying the smart money is starting to sense that the Fed might be stepping in and having to lower rates, and therefore we must be heading into a recession. However, and this is what I've warned all of the traders about, just because you might see this doesn't mean you rush out and change your strategy. As economist Paul Samuelson said, that falling stock prices have predicted 9 of the last 5 recessions. He was just doing it to be funny to say that, yeah, there is some predictive value, but it's still a coin flip. You know, it's really, really hard to say. But the bottom line is, whenever you see these inverted yield curves, at least you'll know why they occur, how it's happening, and why the markets don't like them. So for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a brand new technical analysis course, all at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.